Welcome to the first video on this new YouTube channel. My name is Stock Market Operator Bob. And on this channel we will be focusing on fundamentally strong companies that are currently trading on a discount, and that is why you can call me a Discount Bob. In this first video we will be looking at the French-Italian semiconductor company STMicroelectronics, which is a bit odd. When I think about technology and semiconductors my mind goes to Asia and Taiwan. Just the combination of a French and an Italian tech company should make your survival instinct kick into full drive and your whole alarm system should flash red. When I think about France and Italy my mind goes to food, women and giving up. So what does STMicroelectronics really know about the semiconductor industry? A whole lot it turns out. As you can see on the screen, the company posted their Q1 report on April 27. STMicroelectronics grew their profits 41.5% in US dollars compared to Q1 2022, which is hefty growth. The revenue during the same period grew 19.8%. Looking at the longer term, the company has been showing good and solid growth for a long time. The 5-year annual growth rate of the earnings per share comes in at 21.1%. The growth rate for the revenue during the same 5-year period is 11.7%. The growth is impressive. Almost as impressive as the growth of ballsack injuries in women's sports during the last year. Heading over to the valuation of this bad boy, the company is currently trading at a piss-low PE ratio of 9,0. Why the FCK is STMicroelectronics trading like it is a Silicon Valley bank which Jim Cramer is about to initiate a buy recommendation on. Maybe we could find some good clues about the current valuation further in the video. But how does the current valuation of the company compare to the historical valuation of the company? Has this French-Italian company always been trading piss-low? Oh no! Looking at the 3-year average PE ratio, the company has been trading at 14.3. Looking at the 5-year average PE ratio, the company has been trading at a PE ratio of 24.1. Looking at the 7-year average, the company has been trading at a PE ratio of 31.6. So this baddie is trading extremely cheap compared to the historical averages. So what has happened during the last few years that would bring the valuation down? Well, the Feds and every other central bank in the world has been printing money like there is no tomorrow. This caused the economy to head into some real inflationary pressure. Inflation is solved by increasing the interest rates. Jerome Powell did what had to be done to fix his own mistakes and to bring down inflation. He hiked the shit out of the interest rates. During a time of just 12 months, Powell did increase rates by 5%. He is a hero, not the hero we deserved, but the hero we needed. And because of the increase in rates, the valuations in the stock market need to come down. The earnings yield of each individual company needs to be greater than before to make it an interesting investment. And how does one increase the earnings yield? Option 1 is that the companies increase their profits by a large margin. The other option is lower valuations of the earnings. The second option turned out to be the case for the stock market. So I don't say that all companies should be valued according to the 5-year average. Because the last 5 years have been a literal shit show in the economies around the world. But does STMicroelectronics really deserve to be trading at almost a third of the 5-year average valuation? I don't believe so. And that's why STMicroelectronics is an interesting discounted buy right now. So we do know that the company is growing rapidly and trading at a low valuation. How about the balance sheet? Let's head over. The balance sheet is looking rock solid. Just like a priest at a bar mitzvah party. The debt-to-equity ratio is at 0.53, which indicates that the total liabilities are far smaller than the company's equity. Looking at the net debt, that shows how much net interest-bearing liabilities in the company in relation to total assets. This ratio is used to ensure the company's sensitivity to interest rates and financial risk. A minus value is positive since the company's interest-bearing assets exceed the interest-bearing liabilities. STMicroelectronics has a negative net debt of 9%, which is great. The company also sits at a big cash position. 21.3% of the total assets is cash on hand. Heading over to profitability, the company has been steadily increasing their gross, operation and profit margins for the last 10 years. The profit margin is currently sitting at 25.3%. Free cash flow margin sits at 10.2% and has also shown good growth during the last couple of years. The increase in profitability has mostly been driven by a more effective core business and a profitable product mix. So how does the guidance for the rest of 2023 look, and how about the guidance for Q2, which we are currently in? For Q2, the company expects to see revenue of $4.28 billion, which would indicate a growth of 11.5% compared to the same quarter during 2022. Not bad for a company that is trading at piss-low levels. The company also expects to see the gross margin expand to 49% compared to 47.4% a year ago. For the full year of 2023 they expect revenue between $17 to $17.4 billion, which would indicate a revenue growth of 5 to 10% compared to 2022, which was a record-breaking year for the company. STMicroelectronics expects the growth to be driven by the automotives and discrete product group. The end market for consumer electronics expects further weakness during Q2. But a lot of semiconductor companies expects the consumer electronics market to rebound in the later half of 2023, which could boost further growth for STM if the forecast turns out to be true. Nice. Thus far we see a strong demand in the automotive industries. The electric vehicle sector is hotter than Alexandria Ocasio-Cortez, and I expect STM to take advantage of the situation and continue to post good growth numbers in the automotive sector. So, in summary, if STMicroelectronics were to trade at just 50% of the historical 5-year average of the PE ratio, that would indicate a stock price of $58.80. That leaves the stock with a juicy 38.8% upside, whilst I consider the stock to a very limited downside at this point of time. If the stock were to trade at the 3-year average P ratio, the stock price would be around $67.45. That would be an increase of 58% in the stock price. I have initiated a stock position in STMicroelectronics and I started my buying spree around the release of the Q1 report. I will continue to hold my stock until the stock price reaches $58. If you enjoyed this video, make sure to hit that like, comment and subscribe button. Please leave a comment of what company you would like to see in my next video. My name is Stock Market Operator Bob. And I will be your guide in the discounted jungle.